I look at gold as just waiting. Now, the chart you showed earlier was just a nice little bull flag, and it built a base around 3,300. I look at it as just waiting for a pickup in stock market, U.S. stock market volatility, for its next catalyst to go higher, because that's the key thing I really appreciate in the market.
This is the first week of a 3 to 5 week run. So as long as the market doesn't settle below last week's high, 34.54, or doesn't trade below 34.21, then this market should be bought on dips if you have a 1 to 5 week horizon.
MikeMcGlone, senior commodity strategist at Bloomberg Intelligence, emphasizes that commodities often revert to their cost of production, and crude oil is no exception. He points out that while oil briefly spiked near $80 due to geopolitical risks and supply concerns, the fundamental break-even cost in the United States sits closer to $55 per barrel. Historically, markets tend to gravitate toward this level, and in McGlone's view, the risk is skewed toward oil breaking below $55 and heading toward $40 rather than sustaining levels above $80. This trend reflects deeper deflationary pressures already building across global commodity markets, despite equities still trading at elevated levels. Should equity markets experience a downturn, McGlone warns, these deflationary forces would only accelerate. Turning to gold, McGlone argues that the metal has been quietly building strength, consolidating near record highs since the spring. He attributes this resilience not to short-term speculation, but to powerful structural drivers such as central bank accumulation, global diversification away from the US dollar, and renewed inflows into gold ETFs after years of outflows. He notes that geopolitical shifts, trade tariffs, and political uncertainty have historically acted as tailwinds for gold. Unlike past cycles where gold often faltered during summer trading, 2025 has seen steady demand, suggesting that investors are increasingly hedging against volatility in equity markets and preparing for a broader reset in risk assets. In McGlone's framework, gold is not reacting to runaway inflation, but rather positioning ahead of deflationary trends, which historically have reinforced its role as a superior store of value. From a broader macro perspective, McGlone highlights that the U.S. stock market remains the single pillar preventing a global slide into deflation. However, he warns that expectations for endless equity gains are dangerously stretched. A moderate pullback in U.S. equities could serve as the catalyst for gold to surge well beyond its current base, potentially accelerating toward $4,000 an ounce by 2025. He draws parallels to past cycles, such as the late 1960s and early 1970s, when gold began outperforming equities during periods of structural economic transition. In this context, gold represents stability, while oil and other commodities reveal the mounting deflationary pressures in the global economy. For investors, McGlone stresses, the key lies in recognizing these divergences early, before markets reprice risk in ways that could erase trillions in paper wealth. Before we dive into Mike's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
So what you're showing in that chart is that's the 200-day average of the VIX Volatility Index. It looks like it's an upward trend, and it's actually since President Trump was elected, VIX has been going up. If you just look at a 200-day moving average, now it's kind of hovering right where the bottom was in 2021. And also, I'm showing you in that chart is the Bitcoin to gold ratio. It peaked in 2021 and hasn't been able to go above there since. So Bitcoin has been flatlined versus gold now for 4 years. That's the bad problem. But the thing that's been happening is Bitcoin is there's still more central bank buying. That's significant. In fact, total reserves on a global basis of gold now is actually just surpassed in central banks, treasuries. And ETF flows, David, are significant. So what's very rare is we have total ETF inflows this year up about 11%. That's after 4 years of outflows. I mean, that's a paradigm shift. And the thing is, that very rarely happens in the summer doldrums when we just reached a new low in VIX. Usually when the stock market's going up. I mean, when the VIX is going up. So I think what's happening is people are diversifying out of taking some of their profits in certainly U.S. equities and finding alternatives, and it's global. Remember, the rest of the world is facing unprecedented tariffs from the world's largest goods importer. just getting started, most notably China. So I look at gold as just waiting. Now, the chart you showed earlier was just a nice little bull flag, and it built a base around 3,300. I look at it as just waiting for a pickup in stock market, U.S. stock market volatility, for its next catalyst to go higher, because that's the key thing I really appreciate in the market. When you have complete assumption expectations that the stock market will just keep going up. It's only had 2 down years on a total return basis since the bottom and since 2008. Then you get to the point where it's just tilted. Expectations are just too high. We get some normalization. Gold's figuring it out. And also we're having this issue with, number one thing to remember about gold, gold absolutely loves President Trump. Every time he opens his mouth, the gold market smiles. I mean, we don't have to go into details. The way you said yes, I think you get it. The gold market says, "Oh, Mr. Trump, we love you. Just keep being you," and shifting the world order or reversing and then gold just loves that. Gold, I think, is anticipating normal deflation that follows inflation. That's a typical cycle in history. It always works out that way. It's just a question of time, particularly when you pump up inflation, an artificial money supply. And that's what we did to the peak in 2022. And so the best performing periods for gold are deflation, particularly in dicey currencies. And say if you're in Zimbabwe, you're better off holding gold than any type of Zimbabwean currency or any other country like that. And then deflation, i.e. what happened after the great financial crisis. Now we're having severe deflation in China. Good example is PPI in China. The year over year is minus 3.6%. The bond yield, the 10-year note yield, is 1.79% compared to the U.S. at 4.22%. Now, David, that's despite the fact that money supply in China is running, by some estimates, the latest I check on the terminal, $45 trillion. That's double the U.S. And debt to GDP levels, by some estimates, Goldman Sachs put out 300%. They're doing massive things to prevent the deflation that almost always happens in rapidly advancing emerging markets that revert. So they're playing deflation. The rest of the world's most central banks in Europe are cutting rates, partly because they see it coming. China is exporting this deflation around the world, and there's one key thing. There's one major pillar holding up the whole world from just that normal deflationary cycle, the U.S. stock market. So the key thing I've been watching is gold divided by the U.S. stock market. It just looks like it's just starting to pick up higher, and I don't know what it's going to take to. So let's put it this way: gold divided by the S&P 500 is just bottoming and looking like the pattern looks just like it did in 1967 to 72, right about there at 71 when U.S. went off the gold standard. At the same time, looks like the stock market might be peaking versus the rest of the world's stock markets and potentially GDP. So it's just getting started. That's why I point out, by the end of this year, you and I might have a lot more to talk about. And that's just if we just get a normal pickup in U.S. stock market volatility and just a little backup in risk assets. And that's why I point out to Bitcoin, it's the riskiest of them all. It's led everything on the way up, probably going to leave on the way back down. And I think it's at risk of just dropping to zero.
A little backup by the order of 25% in the stock market. Is that what you said?
Well, here's my base case. I started out the year, I think this is going to be a down year for the stock market in the beginning of the third 50% drawdown in the S&P 500 since 2000. Not so profound. We've already had 2. How about another one? The difference this time is from the highest levels ever, and we have the most mercurial, discombobulating government ever in this country. So also the tariffs. What's the main thing the tariffs do? It cuts off profits. It's a profit. It takes out those profits that all these entities are using when they're offshoring. Now, okay, they're going to hurt earnings. And it's just the key things are way overdue for a little recession. So these kind of things happen when you least expect it. Yes, been wrong. Some of us expected this 2 years ago. It didn't happen. But now we have a major catalyst, and we're not even near there yet. So on the year, the total return to S&P 500 is about 10%. That's great. It's already priced in. It's done. It's been a good year. And gold seems to be anticipating this risk off, low volatility, ancient store value, beating everything, David, is possibly telling us that it's expecting a front running or signaling that we're going to have more of a down or just more of a normal downdraft in the stock market. Now, gold could turn out to be wrong. And we'll see that by the end of the year, but I'm sticking with the rock versus stocks.
VinceLanci, a seasoned commodities trader, emphasizes that the Federal Reserve is now caught in what he calls a no-win scenario. If rates remain elevated for too long, the strain on corporate balance sheets and government debt service will become unmanageable, increasing the risk of cascading defaults. But if the Fed cuts too aggressively, it risks fueling a loss of confidence in the dollar and triggering an even larger wave of demand for gold and silver. Vince highlights that this is why precious metals are beginning to trade less as a pure inflation hedge and more as a safeguard against systemic instability in monetary policy itself. He also underscores that markets don't simply wait for the Fed, they anticipate. While history shows gold thrives when the Fed pivots to easing, Vince points out that silver often magnifies that move, benefiting disproportionately when investors sense a credibility crisis in central banking. In his view, silver's smaller market size and dual role as both an industrial and monetary asset make it particularly explosive in such turning points. If equity markets buckle under the weight of high borrowing costs, and the Fed is forced into rapid reversal, both metals could surge, with silver leading the charge in percentage terms.
Effectively tolerating higher inflation, gold and silver rallied as markets priced in cuts of 25 to 50 basis points, though rising long-term yields signal deeper inflation concerns. India's treasury sales and gold buying alongside BRICS ties reinforce bullion demand. With key payrolls and CPI data ahead, payrolls more important, the Fed's September 17th decision looms as a catalyst for the next move. The full analysis is in the premium post just sent out. Gold inflation reignition is coming. Next, just some of the posts that we sent out over the weekend, and we're just going to give you a quick of, because there are different categories. There's so many categories for gold right now. On the 31st, before the reopen, we looked at the CFTC. We didn't have a Sunday discussion, and the first words out of our mouths alone were, holy shit, because the macro discretionary, much to our pleasant surprise, and we go into why that happened. And essentially, we were saying the market will be higher over the next week to 5 weeks in that conversation. India buys gold. This happened over the weekend during the Shanghai Cooperative Summit. India buys gold, sells treasuries deep in China ties. That explains the situation right there. Gold and silver soar in Labor Day. That's more of a breakdown in all the events, tying it all together. Founders, why gold is rallying may be complex. We're going to touch on that a little bit, but the insights from banks, founders say. Miners, the U.S. pushback. Not founders, miners, the U.S. pushback. That explores, without saying the phrase, explores the potentiality of nationalization of mines. Founders, mining, and the new protectionism, similar concept. How much more gold do central banks need to buy? That was an extrapolation based on some BOA analysis and our follow-up on it of how much more gold would central banks need to buy in dollar terms and in ounce terms. And it comes out to be about $2 trillion at current prices. You can see all those posts. Coming soon, BRICS versus G7, the cause of it all, the case for gold hits 20,000. That's not our case, but a couple people are saying it. Some of them have great reputations. We're going to break it down and go through it at some point during the weekend. Moran's Mar-a-Lago plan revealed. We had that ready, but we didn't send that out over the weekend. There was just too much going on. BRICS versus G7, the cause of it all, is a replication of a lecture that I gave in 2022 to students about why we were where we were right after COVID. Data on deck. Labor Day was yesterday, PMI, and Friday is the big one. We're going to spend a little bit more time on charts today because it's a tactical moment. We said silver to 40 before gold to 3,500. That happened. This won't hold much longer. That was done. Today, we're going to focus on why you do not add to, you do what you want to do, okay? But we're talking to ourselves here when we say you do not add to longs here. I expect a minor swoon. Think of 3,500 like 2,000 was. It flirted multiple times, but only really was broken when it closed above 2009. So call it gold at 3,509. This is a long wick above where we believe the BIS selling was before. You may or may not remember. I talked about it in the past where the BIS would cap rallies and would go sideways. It did it in December of 2023, 2 months of sideways. And we believe, I mean, I believed it before, but I kind of backed off on it because I saw producers selling as well. I believe they capped it back in April. And since then, producers have been selling. And I believe someone's back there. I'm not completely convinced we're not going up. Okay. The next $50 could be lower, right? If you're looking for insight on if you should book profits, that's up to you. Remember, there are exotics in this market as well. We'll go through the charts in a second, but before we do, I'll give you some levels. This is the calendar for the next 13 days. Non-farm payrolls is this Friday. That's the big one. But the other big one that really no one's talking about yet, except for Zero Hedge and I think Goldman, preliminary benchmark revisions for BLS. Last month, they revised them down. Last year in September, they were revised down. So BLS is just basically a shit show when it comes to reliability, and you can guess why. But the revisions lower could seal the deal for Powell, which is why he cut a year ago on September 18th, that and the political issues. PPI and CPI, normally very important, and they are very important, but they're secondary now. Remember, he removed the average inflation target concept, which got him in trouble in 2020. And he's essentially raised the target to 3%. That's what I see. September 16th and 17th is when the Fed meets, and that's when the decision will come out. So it's either 0, 25, or 50. So assume it's 0 if you think we shouldn't cut and you think he's going to listen to himself. Assume it's 25 if nothing else changes, everything comes in as expected. And then assume that 50 is on the table if revisions are big lower or if non-farm payrolls hit very low. Everything else is a speculation. Okay, so I gave you an idea of the of why the rationale is. Here's how it works when it comes to this stuff. Here's the hourly. Okay, I'm going to tell you a story because this is what happened. People are buying for various reasons. The Fed's going to cut, long-term bonds are having trouble, liquidity issue, bonds are weak, et cetera, yada, yada, yada. All right, so they're buying for various reasons, right? Then it gets to here, and the previous high is here, and there's a long wick there. And after this long wick, the market goes sideways for 4 freaking months. That can't prove me right or wrong, but I'm right. That's the BIS. BIS capped in December 23 and caps it at various levels to let the market catch its breath, to let people calm down, to be a circuit breaker. And then inside of here, this was the producer selling there and there and there. And now it's done. Now, maybe there's more producers selling up here. I don't know. But now it's done. So now the market wants to retest where the final boss is. It retests it. It breaks it. And that's arguably saying we have a new high. The market can go higher. No, you can think that. But here's what you should think. It broke it. The market collectively was fishing for stops. Are there people who want to buy it above there? And what did it find? It found selling. So there's more selling above 3,500. It's not to say it's the BIS. It's not to say it's producers. It could just be funds taking profits. It could be bearish funds that want to sell new highs. It could be a lot of things, but you do not buy a market that makes new highs and then goes back under the old highs.
When interest rates remain elevated for an extended period, the ripple effects spread far beyond credit markets. Higher borrowing costs slow down economic activity, weigh on corporate earnings, and increase the risk of defaults, particularly in heavily indebted sectors. As stress builds, investors instinctively seek assets that hold their value independent of financial engineering. Gold and silver stand out as natural refuges in this kind of environment. On the flip side, if policymakers reverse course and cut rates aggressively to rescue growth or stabilize markets, the result can be just as supportive for precious metals, but for a different reason. Rapid monetary easing undermines trust in currencies themselves. Gold, with its deep historical association as a store of value, usually attracts the first surge of safe haven flows, acting as a shield against uncertainty. But silver's smaller market and hybrid role as both an industrial and monetary asset often turn it into the explosive outperformer once momentum builds. Its sensitivity to shifts in liquidity and economic confidence makes it far more volatile, but also capable of outsized gains when fiat credibility begins to erode. That's it for today. If this video provided value, please like, share, and comment below with your thoughts. Your perspective helps deepen the conversation and keeps everyone informed.